You wake up to a green index and a red portfolio. That's not a bug. It's the market you think you own versus the market you actually own. Your diversified index is a concentrated tech bet in disguise, and in 2026 that hidden bet might be the entire story. If that stings a little good, stay with me. In the next few minutes, we're going to open the hood on how markets are really moving, why both the bulls and the bears might be right, and the one mechanism almost nobody hedges for, the meat grinder in the middle. Quick question to start. When you look at your portfolio, do you feel diversified or exposed? Tell me in the comments with one word, diversified or exposed. I'll tally it. Here, why this matters now. Last year felt surreal. Unemployment stayed low, consumers kept spending, chip names went vertical, and the big indexes looked invincible. But zoom in. A handful of giants pulled most of the weight. Passive money kept buying what was already big, multiples stretched. And underneath, credit and earnings did just enough to keep the party going. That's not a stable equilibrium, it's a balancing act. Let's build the map, simple language, no sugarcoating. Step 1, how the machine is moving money. Most of the fresh dollars in the stock market don't arrive as a person picking stocks. They arrive through products that track indexes, funds that buy more of whatever's already big, market cap weighting. If one company grows to 8% of the index, every new dollar that tracks that index buys 8 cents of that one company automatically. No debate, no due diligence, just pipes. So when a giant rallies, it gets bigger in the index. Getting bigger means it captures a larger share of every new passive dollar. Those dollars push it up more, that pushes the index up more, that attracts more dollars. Beautiful flywheel, right up until a wobble turns into a slide and the same pipe sells more of what's falling. That's the hidden mechanism. Step 2, the pricing lens. Prices don't move just on hope. They move on two levers, earnings and the multiple investors will pay for those earnings. Multiples are a mood. They expand when money is easy and the future looks smooth. They compress when money is tight or the future looks foggy. Interest rates are the dimmer switch here. Lower rates make future cash flows look brighter today. Higher rates dim them. Simple. Step 3, the push from policy. Monetary policy is the Fed's job. It cut late last year and may cut again. Fiscal policy is Congress and the White House. That spigot has been wide open. Large deficits, sticky programs, big public investment. Money is a scalpel. Fiscal is a fire hose, both matter. Together, they create the backdrop where risk assets breathe. Now the uncomfortable math. Let's make it tangible. When an index trades far above its long-term average multiple, two things have to happen to justify it. Either earnings must grow fast enough to fill the price you've already paid, or the multiple has to come down gently through time or abruptly through price. There isn't a third path. If the multiple drifts down over 2 years, the earnings growth has to run hot just to keep prices flat. If earnings stumble, prices do the adjusting. And because the top of the market is so heavy, one stumble up there can shift the whole index. A 10% slide in a megacap doesn't stop at that ticker. It leaks into the ETFs, into sector funds, into the benchmarks used by pensions and 401(k)s. The mood shifts, the pipe sells. That's the part that keeps me cautious. But let's be fair, the optimistic case isn't imaginary. In fact, it's perfectly logical. If rates grind lower, the discount rate falls. Cheaper money tends to push multiples up or at least keep them from compressing. If the economy avoids a hard landing, companies can still grow earnings. If government spending stays high, demand doesn't fall off a cliff. If margins hold, cash piles up and buybacks resume. In that world, indices can drift higher even if the average stock feels stuck. You've lived versions of this already. Here's the irony. Both stories can be true in the same year. Early year momentum cuts land. Mid-year wobbles as growth cools. Late year chop as expectations reset. It's why so many smart people disagree and all sound convincing. Let's sharpen the picture with a few real-world signals worth watching. Credit spreads. When the distance between risky bonds and safe bonds is narrow, the market is telling you no default wave is coming. When that gap widens fast, risk gets repriced. Translation: if high-yield spreads blow out, equities usually notice. Earnings revisions, not the headlines. The quiet changes analysts make every week. If more companies see forecasts revised up than down, breadth improves. If revisions roll over, enthusiasm fades. Real yields, the inflation-adjusted 10-year is the underappreciated villain. When it rises, growth stocks feel it first because their cash flows are way out in the future. When it falls, the pressure lifts. Liquidity, the net supply of dollars in the system, think of it as the tide. Central bank balance sheets, treasury cash management, money market funds. When the tide rises, it hides rocks. When it falls, you find out who can't swim. Okay, the part you clicked for, hype versus reality in the big theme that lifted everything. The demand story is obvious. Computers are the new oil, chips, memory, networking, data centers, power. The picks and shovels arms race has been profitable for the leaders, but the adoption story inside the average company is messier. Training models is expensive, running them at scale is energy hungry, talent is scarce, workflows take time to rebuild. For a few firms, the return justifies the bill. For many, the bill arrives before the return. The stock market priced the leaders as if their runways were near frictionless. Sometimes that's right, sometimes it's early, and occasionally it's ahead of physics. There are real-world bottlenecks, grid capacity, specialized memory supply, optical components where timelines slip. If timelines slip, revenue recognition slips. If revenue slips, multiples do the heavy lifting until they can't. This isn't a doom story, it's an allocation story. The winners may remain winners, but the path likely gets rougher. Narrow moats widen for some, for others, copycats and cost curves catch up. Markets will try to price that every quarter in real time. They won't always get it right. Pause here. Where do you see genuine returns today? Chips, software, infrastructure, or the power grid that feeds it all? Drop your answer in the comments. I'm building a heat map from your responses. Let's widen the lens of risk. Concentration? We've had top-heavy markets before, but the combination of top weights, options activity in a few names, and the scale of passive flows is new. A small move in a giant can create mechanical flows in both directions. That's market structure risk. Not just valuation risk. Policy constraint. Cutting rates helps until inflation flares again. Spending supports growth until the bond market demands a higher risk premium. Neither line is straight. Both bend at inconvenient moments. Consumer stamina. Households are still spending, but watch delinquencies on credit cards and autos, the savings rate and wage growth versus inflation. If the gap narrows the wrong way, demand cools. Not a crash, just a draft you can feel. Energy. A spike changes everything. Costs rise, margins compress. Central banks tighten or pause. It doesn't take a war, it can be a refinery outage or a shipping bottleneck. Low probability, high impact. Now, the uncomfortable middle. The scenario no one prepares for because it feels boring until it is. Sideways, wide ranges, sudden rotations, headlines flip, breakouts fail, pullbacks stop just above where value buyers want to buy, volatility bleeds until it erupts. It's the market that punishes overconfidence and indecision equally. In that environment, managing risk and expectations matters more than having a genius macro call. If that middle path is the base case, what does surviving it look like? Keep position sizes sane, respect your stops, rebalance on a schedule, not on a mood.